The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I would like to welcome you today to our webinar on investment strategies for reducing the carbon exposure in your investment portfolio, or as we like to call it here, aligning your investment portfolio with your personal goals. Before we start, I'd like to go over a few housekeeping items. I'd like to remind everyone to join us for our upcoming webinars. The next one is our President and CEO, Jamie Upson, will be presenting on everything you ever wanted to know about estate planning on Thursday, October 19th at 10 a.m. I'll be back again presenting on Monday, October 30th for our inaugural CIO's Corner at 11 a.m., where I'll review the third quarter and discuss the investment landscape. If you'd like more information on any webinars or any information, please visit us at our website, www.stonehearthcapital.com. We have all information of our upcoming webinars, as well as an archive of our past webinars and white papers. In terms of questions for today's presentation, we'll be collecting them throughout the presentation. On the lower right-hand side, you'll see a little box that's called questions. You can type them in as I'm giving the presentation, and my colleague Amanda Murray will gather them up and ask them at the end of the presentation. We've left plenty of time for questions, so please feel free to ask anything. For those of you on the webinar for the first time who do not know Stonehearth Capital, we are a financial advisor firm, been around in business for about 30 years. I am Chris Gauthier, the CIO of Stonehearth Capital Management. I have been in the industry for over 20 years and at SEM for the past 5. I am responsible for all investment programs and strategies at Stonehearth Capital Management, including our strategies for reducing carbon exposure in your portfolio. So with that, let's jump right into the presentation. So the first thing we got to talk about in reducing carbon exposure is why would someone want to reduce their carbon exposure in their portfolio? And to me, it really comes down to two simple facts, two main facts that we're going to talk about today. So the first thing is, why do we really want to reduce fossil fuels in your portfolio? The first, like we mentioned in the beginning, is we want to align your investments with your values. You've worked long and hard to accumulate your wealth. It is yours, and it should reflect your personal values wherever possible. So the first thing we want to do is make sure that your values, your investment capital is aligned with your values. The second issue that we want to reduce carbon exposure that's not apparent to most people is we want to reduce the financial risk of fossil fuels. There is a financial risk. Again, if you believe climate change is real, if you believe that the fossil fuel industry plays a big part in this, there is a financial risk to holding some of these companies in your portfolio. And we'll walk you through how that is and where the value could be. The other question I get a lot when we talk about reducing fossil fuels is that people seem overwhelmed. They look, I get it, carbon exposure I want to reduce, climate change is happening, it's real, but I have a small portfolio. What can I do to actually affect these large corporations? There's storms happening in Florida, storms happening in Texas, the ice sheets are melting. What can I do with my little portfolio to help? Well, every time I hear these questions, I always think back to the late South African Archbishop Desmond Tutu. And he had a great comment and really put these things in perspective. And it is, do your little bit of good where you are. It's those little bits of good put together that overwhelm the world. So while we may not be the big player, we're not a CalPERS, we're not a huge player in the game, a bunch of small people getting together, using their collective portfolios can help change the world. So what do we mean when we talk about aligning your investments with your values? Well, the first thing is you believe climate change poses human, environmental, and economic threats. You believe the threat is not in the future, it is now. Climate change is happening now. This is not a 2050 problem. This is not a year 3000 problem. This is not my great-great-grandkids problem. It's happening now, and we can take concrete steps to help solve this problem. And by solving this problem, you and your family can express your concerns about the fossil fuel industry's role in this climate change and take concrete action. That's part of a larger movement. So that's aligning your values with your goals in your investment portfolio. Now, the next piece that we talked about was reducing the risk of fossil fuels in your portfolio. So what is this risk? So if you think about fossil fuel companies and how you value companies, they have assets. They use those assets to create income streams that are, again, distributed to shareholders. So valuing fossil fuel companies, they're based on the reserves they hold in the ground. And part of the value to that is that they're going to bring those to market, and we're going to burn carbon into the atmosphere. The assumption is that all assets will be extracted, sold, and burned. But is that really a realistic assumption? So when you look at the science behind it, the fossil fuel industry has 5 times more carbon in coal, oil, and gas reserves that can be safely burned to not exceed scientifically accepted levels. What are these scientifically accepted levels? Well, if you follow the science behind this, there's a train of thought out there that we need to keep the temperatures below rising 2 degrees Celsius. And if we just burn a quarter of the fossil fuels that we have in the ground, that we're not going to be able to keep those levels. So in that, it affects climate change, temperatures warm, and we've seen the effects throughout the Earth. The other thing that could happen is that carbon emissions, and hopefully Washington comes around to this, they start taxing, or cap reserves may no longer be assets for the company. What that means is the value of the carbon in the ground that we value at, say, $30 a barrel of oil, if they tax 10%, 5%, 15%, that's worth a lot less. So now the value of the company you thought Exxon maybe was worth $100, it's now only worth 75, 70. That directly flows through to your portfolio. So it not only hurts the company, like ExxonMobil, it also hurts investors, because you are left holding these devalued assets. In the end, that's what we're investing in. We're investing in companies and their return streams going forward for the next 5, 10, 15, 20, 30 years. And if companies come to the conclusion that they can't burn the carbon they have in the ground, if government comes around to start taxing or capping these fossil fuels we have in the ground, then those assets are worth a lot less. That directly affects the returns you can expect going forward in your portfolio by holding energy companies. So that is a large risk out there in the market. We take that into account when we build portfolios. And this is one way to kind of reduce that risk. So to reduce the risk and to align your values with your portfolio, your investment portfolio with your values, how do we go about doing this? Well, right now in the marketplace, the biggest way to do this is negative screening. You can see over 61% of the investors use this to reduce carbon fuel in their portfolio. We don't think this is the optimal way to do it. And the way to think about negative screening is, again, to use ExxonMobil. I use them as the boogeyman all the time. So if I ask 100 investors that in a fossil fuel light portfolio, would you hold ExxonMobil? No hand goes up in the room. It never fails. Nobody raises their hand. The next question I ask is, well, in a CarbonLITE portfolio, would you like to hold the company that is one of the top 3 investors in renewable and wind and solar power? And everybody raised their hand. Of course, I would love to invest in that company. Well, that company happens to be ExxonMobil. So we think negative screening, you can miss some really valuable companies that are doing some good in this to help the climate change. It also leads to concentration risk. And what that means is when you negative screen and start kicking investments out of the portfolio, you end up with a very concentrated portfolio. You remove all the energy companies. Then you remove the basic material companies that use carbon. Then you remove the producers. Then you remove the big users of carbon, the utility companies. You're left with a very small universe of stocks you can invest in. And it leads to concentration, increases the risk in your portfolio, which jeopardizes your chances of achieving your financial goals, which we don't think is the right way to build a portfolio. The other few ways that investors do the positive and negative screening. So you just take that negative screening and then you go look for good companies that are doing well. You look at Vestas, like a wind company out of Denmark, or you look at Tesla, an electric car company who's trying to build batteries to help the climate change. Well, again, that you cannot remove that concentration risk. You end up with a very concentrated portfolio, a very high risk portfolio that could jeopardize you meeting your financial goals. And then there's a small selection to do positive screening or just engagement or low carbon indexes. And those are all fine solutions. We just don't think it's right for an entire portfolio. It's right for a piece of your portfolio, not the entire portfolio. What we've come to the conclusion is portfolio footprinting analysis is the way to go. And that's how we've designed these portfolios based on this portfolio footprinting and analysis. We're gonna go through the reasons why we chose this, but the biggest reasons is, again, we remove that concentration risk. And also by doing portfolio footprinting and analysis, we are able to quantify how much are we actually saving. We can measure it, we can compare it, we can compare portfolio A to portfolio B and actually calculate how much are we really saving by doing this. And again, when we look at the objective functions of portfolios, that's part of the decision tree process. It's just not, I want to reduce fossil fuel exposure. I want to find out how much am I reducing my fossil fuel exposure? Can I still meet my goals? And is one portfolio better than another? And portfolio footprinting and analysis really allows us to do that in a measurable, quantifiable way. So let's look at what is carbon footprinting, because most people aren't familiar with how this is calculated. So the carbon footprint of a fund is calculated by just tracking and measuring the greenhouse gas emissions of all the companies in a portfolio. So you hold a portfolio of diversified ETFs. Those ETFs are made up of individual companies. And what we're able to do is at the individual company level, we're able to track and calculate how much carbon emissions they are emitting in individual companies. You add that all up at the market cap weight that hold in the ETF, and you come up with this carbon footprint. How much is the carbon footprint of this portfolio? The data is provided by your SRI and South Pole Group. And the reason we use this group is, first and foremost, they're nonprofits. They've been involved in climate change action for many, many years. They're not doing this for the almighty buck. They're not trying to sell data to anybody. So they don't have their own agenda. Their own agenda they have is that we want to reduce carbon footprint. We want to give investors the tools to use to make their own decisions. So we think it's a better way than going through a company that has this data and is trying to use it to increase their balance sheet. So how do we express this carbon footprint? It's expressed as TCO2, which is just pretty much carbon dioxide equivalents in the tons. This is tons of carbon dioxide equivalent per $1 million by any company. And yes, tons is spelled T-O-N-N-E-S. It's a metric ton. It's worth 2,000 pounds. The ton you're more familiar with in the US probably is the regular ton, T-O-N, which is a little under 2,000 pounds. We call this a heavy ton. We are one of the few countries that don't use the metric system. So in terms of gathering data, this is the way it's expressed. So anytime you see TCO2, you can think tons. So why do we choose carbon footprinting? Again, when we talk about this, it allows for portfolio comparison. You can take portfolio A, calculate the carbon footprint of it, take portfolio B, add up that carbon footprint, and compare the two on a carbon exposure basis. And you can actually see the underlying carbon footprint and decide if I move from portfolio A to portfolio B, does it make sense for me? Am I getting the bang for the buck? Am I reducing my carbon footprint enough to make it worthwhile to make this move? It is quantifiable and measurable. Again, in order to compare portfolios to portfolios, you need to quantify it and you need to measure it. A lot of people just go, I don't want to own fossil fuels, get me out of all fossil fuel companies, and they build a portfolio that way. Well, the questions I think they're missing is, well, how much did I reduce my carbon footprint by? Is it worth it with cause the increase of expenses? Maybe a little bit more concentration risk. Is that portfolio measurable? Can I compare that to my other portfolio I hold right now? And allows us to, again, control for that concentration risk. Because again, when we look at the portfolios here, we're really trying to achieve a financial goal. And the secondary objective is to reduce the carbon exposure. So we want to always make sure that we meet that primary goal of your portfolio is to meet your financial goals. So at Stonehearth Capital Management, we have 3 diversified portfolio models: conservative, moderate, and aggressive. And now what we're going to do is go through and kind of see what our objective is for these portfolios. It's CarbonLITE diversified. We have a version for each different model we have: conservative, moderate, and aggressive. The first thing we want to note here is that we only adjust the equity portion of your portfolio. We're not changing anything in the fixed income or the alternative space. And the reasons why is that the assets just aren't out there. We don't have the data to understand if I remove from bond A to bond B, or I take bond portfolio A and move it to bond portfolio B, how much am I reducing my carbon exposure? The data is just not there yet. I do think that the market will evolve and we will have the opportunity to apply this type of methodology to the fixed income and alternative space. We're just not there yet. The data is not there and the investment vehicles aren't there yet to build a portfolio. So the objectives of our portfolios are: number one, reduce the carbon footprint of the assets. Again, small changes make a big difference in this world. So again, we're not trying to do a totally carbon-free portfolio. We're trying to take small steps that when taken together across many, many, many investors, we end up changing the world. As Desmond Tutu said, the little bit of good where you are, it's those little bits of goods put together that overwhelm the world. One of the secondary objectives is we want to maintain a similar risk profile to our standard risk models. So if you come in and you're a diversified moderate investor, we're going to go ahead and reduce your carbon footprint. You believe in climate change, you believe there's a risk to holding fossil fuels in your portfolio, and you want to reduce that risk. We want to keep you in the same risk level. We don't want to take a moderate investor and then move them to a conservative portfolio just to reduce their carbon exposure. Because again, these are assets you've worked long and hard to accumulate. They're there for your retirement. They're there to leave to your heirs. They're there to leave to charity. You don't want to risk not achieving those goals by moving to a CarbonLITE portfolio. So you want to make sure that you maintain your proper risk in your portfolio. The second is we don't want to pay a lot for this. Again, we want similar expense ratios. This is something that's been around for ages, and we're just doing this now because there are new vehicles out there that allow us to maintain a similar expense ratio to a typical diversified portfolio and still achieve these goals. The one problem we had doing this 2 or 3 years ago is that the amount of expenses that you had to pay to achieve this, we think, ended up hurting clients in terms of meeting their financial objectives, and that's something we would never do with anybody's portfolio. Because again, when we look at this, what is the primary objective of all these portfolios? The primary objective we always have for all our portfolios, including the CarbonLITE suite, is we want to maintain the ability to meet your financial goals. And we would never jeopardize that by moving to a totally carbon-free or moving a portfolio to different risk levels. So now we've kind of go through the why and the how we do this. We're going to take a look at our individual portfolios, see what we can actually accomplish by maintaining all these similar objectives. So we'll start off with our conservative portfolio. These are investors who are a little bit less risk tolerance, more maybe closer to retirement. Again, every individual's situation is different, but you're a little less risky than the average investor. You would like a conservative portfolio. When we look at the chart we're looking at right now, the first thing you see is our typical diversified conservative portfolio, which is right here. So at the asset level, big asset class level, fixed income, US equity, international equity, and alternative, the first thing that jumps right out at you is that by moving to a CarbonLITE portfolio, by reducing your carbon exposure, we don't change your overall asset allocation. And to us, that is one of the main goals here that we want to achieve, that by reducing your carbon exposure, we don't change the overall risk profile of your portfolio. As you can see right here, we don't make big changes. We stay similar asset allocation, and the differences are 0. The next thing you're seeing is the difference in the risk score. Now, we use a third-party software called RiskStreamer. You may have heard this as crash test score. When talking to your advisors, you may have heard them talk about this is your crash test score. Well, the crash test score, for those of you who are not familiar with it, is simply a number between 0 and 100 to judge how risky your overall portfolio is based on scenario analysis. And what that is, it's just a program that goes in and says, if A was to happen, if another 2008 financial crisis was happen, what would this portfolio do? If the Fed raises rates up to 3 or 4%, what would this portfolio likely do? So again, keeping with that quantifiable and measurable goal, we are able to evaluate what portfolio A would do compared to portfolio B, compared to portfolio C. Again, these are predictions of the future. Nothing is certain, but it gives us a very good idea of how risky a portfolio is. And for those of you who want more information on this, I highly encourage you to call the office and to talk to Jamie Upson and talk to David Giuliano, or call me, Chris Gauthier, and we'll kind of go through the score. It's a very powerful, very intelligent tool that we use to build portfolios. So the change here you can see is minimal. If you're a typical conservative investor at Stonehearth Capital Management, your RiskStreamer score is a 38. By moving to that CarbonLITE portfolio, reducing the carbon footprint, we don't change that score. So the way to take this is, by doing this, we don't change your risk level. You stay at the similar risk profile. The next piece we have to look at is expense ratios, and this is where we see the first change in our portfolios. So a typical conservative investor at Stonehearth Capital Management has an expense ratio, not a management fee, an expense ratio of the underlying products of 45 basis points, which is very competitive in this landscape. When we move to the CarbonLITE conservative model, you can see that your expense ratio does go up a little bit. It goes up about 9 basis points. Again, some of the products we use to reduce that carbon footprint, which we'll go over in the next few slides, you see that they were a little bit more expensive than our typical products, but not that much. So again, when we talk about quantifiable and measurable, we understand that we're keeping our typical asset allocation as a conservative investor. We're not moving our risk score at all. We're increasing our expense ratio a little bit by 9 basis points. But what do we get for that 9 basis points? What are we actually achieving by increasing your expense ratio by 9 basis points? By doing that, we are able to reduce your carbon footprint in your portfolio by 40%, or a little over 40%. A typical conservative investor right now has a carbon footprint of 36 per 1 million invested. So when you look at that number, that is not your actual carbon footprint. That'll vary depending on how much money you have in your portfolio. As you remember, we talked about you want to be able to compare portfolios, have it quantifiable and measurable. You want it on an apples to apples basis. So what we do is we equalize everything at $1 million. So when we calculate a carbon footprint, and you see this on any of our presentations, it's always based on $1 million portfolio. But again, that's so we can compare apples to apples. Everybody's going to be different, but by taking your portfolio value, we can run it through our software and get your actual carbon footprint. But for a typical investor, we would expect to reduce your carbon footprint by over 40%, which is meaningful. That's over half cutting your carbon exposure with very insignificant changes to your entire portfolio. Again, typical asset allocation, same risk score, a little bit higher expense ratio, and a lot lower carbon footprint. Moving up the risk scale, we move up to our moderate portfolio. Again, what changes do we have to make to achieve our objective of reducing our carbon footprint? Again, same at the asset allocation level, no changes. In a typical moderate investor, they hold 34% US equity. If you move to your CarbonLITE version of a moderate portfolio, you still hold 34% US equity. So again, no changes. The risk score changes a little bit. We do reduce the risk a little bit in your portfolio by about 4. So your score goes from 55 to 51. In my many years using the risk streamer score, again, it's not an exact science. There's not much difference between a 55 and a 54, 55 and a 56. So 51 and a 55 are very similar in their risk profile. So by this change, what are we able to do for the expense ratio? Again, goes up a little bit. A typical moderate investor has 41 basis point expense ratio. Our CarbonLITE version has 58, again, going up by 17 basis points. Again, a small jump in the expense ratio, but what do we achieve by increasing your expense ratio just a little bit? A reduction of over 30% in your carbon footprint. A typical moderate investor has a carbon footprint of 106. By moving to a CarbonLITE moderate version, you can reduce that down to 70. And again, you got to remember what we're doing here. We're not touching the fixed income piece. We just don't have the data. We can't adjust it. Same thing in the alternative space. There's no way to quantify and measure what our carbon footprint is. So we're just adjusting the US equity and international equity piece. And as you move up the risk profile, going from conservative to moderate, equity becomes a bigger piece of your portfolio. So you see bigger changes to the overall portfolio level. So again, that's why the carbon footprint is a little bit higher for a moderate investor, because they have more equity in their asset allocation. So the last portfolio we have is an aggressive investor. Again, we're going to see a lot more equity exposure in the portfolio, but again, no overall change if we move from aggressive diversified portfolio to an aggressive CarbonLITE diversified portfolio. Extreme score, even more adjustments. Again, we have more equity. You can see bigger changes. Your risk score comes down by about 6, but again, still within the similar risk profile of a typical aggressive investor. Expense ratio rises a little bit more than the other two portfolios. Again, we have a higher weight to equity in our aggressive clients, so you would expect the expense ratio to go up a little bit more. It does go up by 22 basis points. But again, what do we achieve by this small increase in the expense ratio? Able to reduce your carbon footprint by over 40%. So again, these are very meaningful numbers. This isn't just blindly going in and removing energy companies. This is a very thoughtful, thought out, quantifiable and measurable process that you were able to achieve your financial objectives, also measure how much carbon you're actually reducing in your portfolio. So you can judge for yourself, is it really worth it in my personal values in my portfolio to increase my expense ratio by a little bit for this reduction in the carbon footprint? And again, you're a small player in a much bigger world here that's going on. But again, if you do your little bit of good where you are, it's those little bits of good put together that overwhelm the world. And by making these small little changes, you take that together, you become part of a larger movement, and we can actually start really making an impact to make this world a much better place for not only us, but also for our kids, our grandkids, and so forth. So now we're going to take a look at the underlying holdings of our portfolio. So what we're looking at here is a typical moderate client, what we use to get the US equity, international, and emerging market equity exposure. So on the left-hand side over here is what a typical diversified moderate portfolio would look like. We hold US equity, we hold a bunch of ETFs. Over here is the weight we hold them in the portfolio. Next line item here, you can see the expense ratio, the yield. And what we're really interested in here is the next column is the relative carbon footprint, again, per $1 million USD invested of each individual holdings. So the way to look at this is we look at the min-vol product, which is USMV. It's 5% in a typical diversified moderate client. It charges us 15 basis points to hold it. It has a yield of 2%, or a little bit over 2%, and it has a carbon footprint of 153. Now, if we hold 5% of a product that has 153 carbon footprint, that equates to a carbon footprint in your portfolio of 7.65. It's just math, 5 times 153. You add all those up at the individual levels and you come to a total carbon footprint of your portfolio. That's 106.48. So this is how we calculate and build up your carbon footprint and can measure and quantify what the carbon footprint is in your portfolio. Moving over to the right, you see a similar chart here, but again, this is the moderate CarbonLITE diversified portfolio. So we still hold USMV, we still hold VNQ. Next line item is the fossil fuel reserve free, SPYX. This is where we start seeing changes into the portfolio, the underlying holdings, reducing the carbon footprint. And we can look at one particular example. If we look at the value here, this ETF, this is what we hold in diversified portfolio, VLUE. It has a carbon footprint of 167. So we take that out of the portfolio, we put that 5% weighting into a low carbon ETF, CRBN, and we reduce the individual holdings carbon footprint from 167 to 52. You do the math on a $1 million portfolio, and that equals to a carbon footprint addition to your portfolio of 2.6 compared to 8.35. Again, adding that last column all the way up of all your portfolio holdings, you end up with a carbon footprint of 69. So this is how when we talk about quantifiable and measurable, we can actually show you what we're getting for this portfolio change. How much is my carbon footprint really moving? And some of these things are really drastic. And the one I always kind of point out, the biggest change is international developed equity. They were a little, again, because they're international, they're a little bit different than US companies. They have a little bit higher exposure to carbon. So if you look at this core holding right here, VEA, that's just an ETF that holds international stocks. Think stocks in France, in Britain, in Germany, all international stocks across the globe. We have a 5% weighting in a typical moderate diversified portfolio. The carbon footprint of that product is 245. Now, is that big? Is that large? I don't know. What I do know is that when I take a weighting of 5% in that holding, with a carbon footprint of 245, I'm adding 12.25 to my total portfolio carbon footprint. What can I do? How can I change that? Well, I can move that into a core carbon-free international index, tracks the same securities, it holds a little bit different weightings of those individual securities, excludes a few, but it has a carbon footprint of 94. So again, 245 compared to a 94. You do the math and you end up with a portfolio carbon footprint addition of only 9.4 to your portfolio. Add that up and you're down to 69.64. So again, measurable, quantifiable. We objectively design these portfolios to be as less disruptive as possible while still reducing our carbon footprint. So again, when we look at the portfolio, we see not a lot of change at the asset allocation level. Everything stays the same. We see a small, but very small increase in the expense ratio. Very little change in the risk streamer score, which is that how much risk am I holding in my portfolio, for a big decrease in the carbon footprint. And we are happy to do this analysis for anybody's portfolio, whether you hold it at Stonehearth Capital Management or you hold it at another company outside. We are more than happy to go through this analysis with your portfolio and to see what carbon footprint your portfolio actually holds. We've done this for a few investors, and it's really shocking that once you kind of calculate this carbon footprint and see what you're actually holding in carbon emissions and what we can do to reduce it without changes, big changes to your portfolio, people's eyes just light up. And I can't believe that for this small changes, we can have this big of impact on the world. And again, everybody working together, making small changes in their everyday life, that becomes a huge impact on the global basis when taken together with everybody. So again, that's kind of the presentation going through what we do. I would urge anybody who wants to go through these portfolio analysis, please call the office, 978-624-3000, talk to Amanda or Christine or Jenna, and we'll get together and go through this portfolio analysis. So again, that's a presentation. I'd like to open it up to questions now. I know Amanda has been monitoring everybody's questions, and hopefully there's a few questions out there that we can answer for you today. Amanda?
Hi, Chris. Thank you. Yeah, we do have a couple of questions, and just a reminder to use the question box or the chat box to submit your questions if you do have any. We'll try and get to everyone's questions in this webinar, but if not, Chris will certainly follow up with you. Chris, the first question I have is, what portion of my investment portfolio should I allocate to this strategy?
Thanks, Amanda. Very good question, and we do get this a lot. So when I give this presentation to groups of individuals or just individual clients, one of the questions that they always ask is, should I put 10%, 15%, 20% into this? Well, that's the wrong question. To me, this is, again, investing with your personal values. You actually believe climate change is real. You believe it's happening now. You believe you can make a difference. To me, that's a personal value judgment. So it's not a return based, it's not a percentage of your portfolio, it's an all or nothing. So to me, to really make sure that you believe in this, I would have a client say, you know what, this is your entire portfolio. We've designed this to be a total portfolio solution, not a piecemeal solution. We've conscientiously made sure that you stay at the similar risk level, similar asset allocation as your current portfolio, and just reducing the carbon footprint. So in general, this should be almost an all or nothing decision. I believe in this, it's my personal values, I want it reflected in my portfolio. It's almost going against that by saying, oh, I only want 10% in my portfolio. So this, to me, really is, you would move your entire portfolio over to this type of strategy.
Chris, we have a couple more here. The next one is, how would I go about investing in this strategy?
Good question. So the first thing to do is to talk with your advisor. Again, this is a long-term solution. This is something that we just don't want to do overnight, that we want to make a rash judgment. This is something that we need to calculate with your financial plan, with your portfolio, and make sure we have all our bases covered. So again, you can call the office, talk to your advisor, or give me a call. We can kind of go through what change we have to make, what tax implications there would be, what are those portfolio implications, and develop a plan where we can move from portfolio A to the CarbonLITE version in a very measured way. Make sure that we're not impacting anything else. Make sure we're not doing a large increase in your tax liability. So I would urge you to call your advisor and speak to them. Just understand more about how we can help you reduce your carbon exposure in your portfolio.
The next question I have is, why don't you adjust the fixed income portion of the portfolios? What about green bonds?
Yeah, green bonds, they're all the rage now. So I'm sure people who are familiar with this space, and most of you who are listening on this call probably are, since you're interested in it, is that you hear a lot about green bonds. Well, it's a very small piece of the market right now, and it's interesting. So to me, a green bond is basically a marketing tool. There's no universal way to calculate whether it's green or not. There's a bunch of people that they fill out a form and say, okay, we're a green bond. It's just dotting the I's, crossing the T's. It's not measurable, it's not quantifiable. You can't calculate how much carbon they're reducing or what they're using it for. And the universe is so small and so many people are interested in it that they're bidding up these bonds. And what that means is demand is outpacing supply. So all these bonds are very rich. So instead of paying $95 for a bond that's worth $95, people are paying $100 for a bond that's worth $95. They're paying $105 for a bond that's only worth $95. We don't think that helps clients meet their investment objectives of financial objectives. It may make them sleep better at night, make them feel better in green bonds, but it hurts them from an investment portfolio, which we never want to do. The second piece is that the data just isn't there. Again, quantifiable and measurable is big here at Stonehearth Capital Management. We always want to understand what we're doing. And by the data for the bonds and the alternative space just is not there yet. I do know a bunch of companies are working on that, trying to figure out how to be able to quantify that. And I do think that this will evolve. And again, as more people come to this space and join us in our mission to help the earth, help climate change, help solve these problems, you're going to see companies come into the space and actually figure out how to calculate a carbon exposure of a bond, how to figure out what's the carbon exposure of an alternative product. So I think that is in the near future, and we were definitely looking into that and doing research on it. And when there's a solution that makes sense from both a financial standpoint and also from a reducing your carbon footprint standpoint, then we would definitely start adjusting it, but we just don't see it in the marketplace yet. There's just not enough product out there.
And Chris, I have one more question here. Is this a ESG or SRI portfolio?
Good question. I was waiting for someone to bring that up. So for those of you who don't know, ESG stands for Environmental Social Governance. SRI is Socially Responsible Investing. It also stands for Sustainable Responsible Investing. And you can tell right away by there's multiple definitions that no one's really convalesced around what that actually means. It's been around in the industry for a while. When I started my career back in the 90s, SRI and ESG were big products out there. And basically, since there's three letters, you have the environmental piece, which is carbon exposure. Social, which is more about supply chains, how you treat your workers. Governance is, are there women on the board? Are we diversified company in terms of our employees? Do we have equal pay for women? And I think those are all very realistic and very concrete goals to have. We've conscientiously designed this portfolio not to take into account the social and governance. We think that that is right for some investors, right for some portfolios, but for this targeted portfolio, we're really trying to meet that primary objective of meeting your financial goals with the secondary objective of reducing your carbon exposure. Again, taking on this battle against climate change that is very real and happening now. So again, we're just focusing on the E. So there are some products in there that do have the S and G in there, but the primary focus and what we always look at is that carbon footprint. So we're really focusing on the E, not so much the ESG or SRI. We do have a diversified portfolio that plays in the ESG space. So if you're interested in taking that other step and going for the environmental, social, and governance, that you can definitely have that discussion with your advisor, because we do have that offering. But what we're looking at right here with this full suite of products, again, is reducing our carbon exposure, helping the earth by helping solve the climate change problem that's going on right now.
Chris, I think that's it for all the questions that we have today.
All right, thank you, Amanda. And again, thank you everyone for joining us. Again, this is a real problem. Joining me on the call, I know that you realize that climate change is happening, it's real, and this is one small step that you can have that can make a larger impact when taken together with everybody. So again, I want to thank everybody for joining me today, and we look forward to seeing you again on our future and upcoming webinars. Thank you.